just always so exciting to have him come and speak to us. So in case you're not familiar with who Jed is my boss. Susan Petrallo works at the Barrington office, and we have some Barrington agents here, so please welcome them. Susan's been with Jed for 14 years, and I've been with them almost 10, so he is one of the many reasons we stay.
Yep, Susan was my first loan officer when we started our platform change over here in Chicago.
So he educates us, and he certainly educates you guys.
Previous presentations that I've done, and really ask your questions as we go through it, because I'm just going to try and work my way through the entire format and hopefully build the story of what I see going on in our economy today. So as the CEO of your business, do you now firmly believe that the economy impacts your business?
Oh, yeah.
And the reason why I say that is because 6 years ago, pre-meltdown, we didn't think that way. We thought, my business is right here in Schaumburg, we're in Barrington, and this is just my little world, and what happens in New York or California, what happens in Russia or China, that doesn't impact me. And what we've learned through this is, boy, do some of these worldwide events impact us. And that the economies today, not just the US economy, but different economies of the world, impact your business right here locally. So we're going to talk about some of that today. So here's a list of some items we're going to go over. We're going to talk about the Fed. We're going to go through some forecasting. We're going to take a look at some regulatory changes, and then we're going to take a lot of statistics within the economy and different economic indicators. So earlier this year, on February 1st, we had a changing of the guard at the Fed. And so Janet Yellen now holds probably the most powerful position in finance in the world. So the Fed chair, Ben Bernanke on the right there, was the former chair, and I do have to just spend a couple of minutes talking about Ben Bernanke, because he quarterbacked us through the entire crisis. His term was up 2.5 years in front of this, but he personally stayed on until we were through the storm, and the ship was right in the right direction before he stepped down. And one of the things is, as the crisis was going on, you know, I was pretty judgmental about what our political system was doing at the time and how it was impacting the crisis. I was also somewhat judgmental about some of the steps that Ben Bernanke and the Fed was taking. But in looking back now, I think some of the steps that they took were absolutely amazing. And we'll talk about some of those items and how they've concluded now as we get through a few things. But once again, this is changing the guard. So then the question that Wall Street and the question that the world had, how is Janet Yellen going to be different than Ben Bernanke? Is there going to be a change in philosophy, a change in strategy? And for the most part, we've all gotten comfortable now that she really is his protege. She thinks that's kind of that similar way. And by the way, Ben Bernanke changed the way the Fed handles certain situations. Greenspan did it mostly, but then he took it even further in some of the directions that he does. The last recession we were in was in 1982. Anybody remember what interest rates were in 1982?
Yep.
Yeah.
Half 21, I think it
Yep.
was.
Yep. And so the last recession, notice where interest rates were. This recession, where did interest rates go? And that is the very key fundamental change about the way that our Fed handles it. They didn't pull money out of the system, they pushed money into the system. And that is such a dramatic change. Okay? Imagine what it would have been like the last couple of years if we've been dealing with double-digit interest rates. How many people would be sitting in this room? I might not even be in this room. Okay? And so the Fed took a dramatically different change. And so really the comparison took place between not just, you know, how does she map against Ben Bernanke, but what about Alan Greenspan, and then what about Paul Volcker, who was the chairman and during the last recession. So I find this analogy really interesting. So if you take a look, notice how interest rates are directly correlated to the height of the Fed chairperson. So if anybody in here is under 5 foot and they want to be the next Fed chair, you can have a shot. But it really, what was that?
Get a little person.
I know. She doesn't look very happy in that photo, does she? So anyway, so I do think there's been a really, from Paul Volcker's years, especially to Greenspan changeover, was one of the first major changes on the Fed strategy. And then Ben Bernanke really took it to the next level. And now I think Janet Yellen is just going to keep going down that same type of a philosophical path of what the role of the Fed really is. So then we talk about what the Fed did. How many heard of QE? Quantitative easing, okay? QE1, QE2, okay? And so what that was, is it was the Fed's stimulus package into our economy. A year ago from today, they were pumping $85 billion a month by purchasing treasury debt and mortgage debt. By doing so, they then control interest rates because they are the largest buyer of both product. And when you're the largest buyer, you can force or set interest rates. And so they push interest rates down by using this technique. Okay? You take 85 billion, you take it times 12, that's a $1 trillion stimulus package per year. You, us, the taxpayer, are now a proud owner of $4.5 trillion of mortgages and treasuries into our portfolio right now. Now here's a kind of an interesting thing. We all know when the stock price goes up, the value of the stock goes up. But what some people don't know is when in a mortgage or a bond, as interest rates fall, does that bond worth more or worth less? It's actually worth more. So all this debt that we have, or all these assets that we purchase, is a better way of saying it. We, the taxpayer, that portfolio is worth so much more now than it was when we took out that debt. The bailout or the stimulus package that they put into play, as they begin, and they have been selling it, they're making a tremendous amount of money. And so the bailout or the stimulus package will not cost us, the taxpayer, 1 cent. It actually is a revenue generator.
All right, I'm confused. Why is that bond worth more again?
Here's the best way of describing it. So if I have a $100,000 bond at 6%, it makes $6,000 a year, correct? And as interest rates go down, and now let's say it's 4%, now it only make $4,000. So the new mortgage will only make $4,000. Make sense?
Right.
But if I'm going to buy that old one that is returning $6,000, I now should be able to get $150,000 for that bond, because that turns around and equates to a $4,000 or a 4% rate of return. As the rate of return goes down, or the market wants, the value of a fixed asset that calculates a higher rate of return is worth more. Okay? And so we have a portfolio. So just take a look at that situation. From 4 to 6, it increased the value of that bond by 50%.
Wow.
So a tremendous amount of stimulus took place. We bought a ton of product. They pushed interest rates down, and now they've been selling it. The last mortgage pool they sold, you, the taxpayer, made $240 billion on that sale. And that goes into the Fed's coffers. And so the bailout of Fannie Mae, Freddie Mac, FHA, all those types of things has never cost the taxpayer 1 cent because of the strategies that they took. It's quite amazing.
Where'd the money come from to buy all these mortgages? Didn't we borrow that from other countries?
We did.
We did?
We sold that debt to China, we sold that debt to other things. But we sold that debt, if you take a look at what the Fed sold, they sold a 0.8% treasury, and they turned around and they leveraged it to buy a 4% mortgage or a 5% mortgage. So think of the interest rate spread that they're making on their money. It is phenomenal the amount of spread that they make. Okay. So now the tapering, as the economy began to recover, and as they saw the indicators taking place, they began to reduce the stimulus, and they wanted to bring it down slowly. Okay? So in December of last year, they took the first step to reduce it, and that's called tapering. They're just bringing it down. And so they tapered in $10 billion steps. So we went from 85 to 75. Notice a month later we went to 65, then to 55, and notice all the steps that they've done. In October, just last month, they made the final decision. Now it's done. There is one last component still in here for the stimulus. That is, every month there is payoffs of mortgages and there's principal curtailment that's going into this $4.5 billion pool. They still are taking those payments, that cash flow, and they still are buying mortgages to be able to control the speed in which rates will be going upward. They want to keep it controlled, but what direction are interest rates going to be going now that the stimulus is gone?
No.
There's only one place for them to go, it's up. They've been held down artificially by our government for almost a 5-year period of time. And now it's time to let them go back to normal market interest rates. And that's what's called the tapering effect.
What will that do to the stock market? Rates going up, it's going to adjust?
Well, have you seen the stock market lately? It broke an all-new high again yesterday. We went through 17,500 yesterday. S&P 500 broke an all-time high, and we're going to take a look at some charts on the stock market. So we'll talk about that. All right. So initially, as you can see, this is the tapering that took place. Initially, this was what we thought was going to happen to interest rates. But because the Fed really has this plan about controlling the rate in which rates are going to be going up, this is now more of our forecast of what's going to happen to interest rates. Okay? So, in the September Fed meeting, it's the first time they came out and really were clear on a whole bunch of topics and more about how they're going to control the rise of interest rates. And so a couple points I want to point out within this. First of all, they clearly stated they're in no rush to increase interest rates. They said that most likely mid of next year, they're going to make their first move in increasing interest rates. So when we take a look at that, their target for the end of next year is going to be 1.25% to 1.5% on the Fed funds rate. They moved Fed funds rate when the market crashed. Actually, I'll skip ahead just so you can see a graph. This is the crash. But how many people remember that in late 2004, they started an increasing of the Fed interest rates, and they took 17 times they increased rates trying to slow down our economy. Everybody remember those days?
Yeah.
And they couldn't slow it down fast enough. And then the crash happened, and they dropped interest rates at the fastest rate they've ever done that. To move it to a 1.25% rate is where it's been at since the crisis happened. Now, they will never do this again. This is one thing that they've learned. The world economies and the US economy now moves at such a more rapid pace of change. They can't take baby steps anymore. I think if we took this graph and we flipped it, this is what the next upward steps are gonna look like. It's gonna be 1% here, 1.5% here, 3/4 here. But this 1/4 point baby step action is done. Okay? By the way, do you think this is healthy? When we're running our federal government at a 1/4% rate?
No.
It is not at all. Question is this what they needed to do? And once again, this is the significant strategy change between the last recession and this recession was the pushing down of interest rates and the putting more money into the economy based on a move. All right. So, actually, I'm going to go back to one more point that they made in that second one. Notice they also stated that by 2016, their targeted core rate is going to be 2.75% to 3%. So they're already telling us this time next year, they're going to move rates up 1%, and this time 2 years from now, we should be up about 2.5% higher than where we are right now. And that's their strategy. They're not trying to shock the system. They're communicating with the financial world, this is our plan. Okay? Then the next thing is they heated up our economy. They pumped a lot of money into this, and our economy has been growing at an incredibly strong rate. We are now almost 5 years removed from the recession. And I still think we all kind of have a recession hangover. And yet we are 5 years out of the recession. So some people ask, why is the stock market at the levels that it's at? Show me any other major country that's been out of the recession for 5 years. It is that continuous growth is why money has been pouring into the US stock markets. All right, so now what they're going to try and do is they want to slow down our economy, because too fast of growing economy gets you inflation and some other negative impacts to it. And so they're going to try and bring that speed down, and notice they want to bring it down to that 2.6 to 3% annualized growth rate. That's their new target. When the recession happened, we went to 10.2% unemployment. Does anybody know what the target was for the Fed to get unemployment rate back down to? 6%. Econ 101. If unemployment is below 6%, you have too low of unemployment. If it's above 6%, you have too high of unemployment. So 6%, or that 5.5% to 6.5% unemployment number, is really the ideal target for them. And we'll get into an unemployment number here in a little bit. And then the last thing regarding the Fed exit is that they're going to be communicating not just with the financial world, but all the different money leaders throughout the world on their strategy. Because the world, every economy now is kind of interlinked, and they don't want to surprise another country's economy based on what the US moves are going to be. So all of our world leaders, when it comes to monetary policy, are now working dramatically closer together in their strategies of increasing or decreasing rates. So an example, a couple days ago, Japan lowered its rate by another 0.25%. But it had communicated with all the major powers that they felt this is why they needed to move it. And so when it happened, the world was already anticipating it. And that is exactly what we're going to do as we bring rates upward. We are going to communicate our actions to limit the impact of those moves. All right, so here we were pre-meltdown. Mid-sixes. And by the way, not one complaint about interest rates back then. Now this is where we have to get our mindset back to, is rates are going to be going up, but they're still really good. How do you think your customers are going to feel once rates go through 5%, or once they get back to a 6% level?
They're not gonna feel good.
They're not going to feel good, are they? And yet, before the meltdown, a 6.5% rate, everybody felt good about it. The first person that has to get their mind around these rates is you. You have to get comfortable that these rates are still good. It is unhealthy for our economy to have the rates as low as they are right now. And them going up is actually a good thing. It is needed to get back to a balanced economy. But we have to educate our customers through this. All right? So, here's the general consensus. I think by the end of this year, we're going to be about 0.25% higher in rate than we are right now. Just because the Fed is making more noise about their move. The tapering this November will be the last month of tapering, and tapering will be 100% concluded. I think this time next year, we will be about 1% higher on a 30-year fixed rate. So now, as the CEO of your business, here's one stat you just need to memorize. A 1% increase in rates decreases buying power by 11%. A $300,000 house today is $267 1 year later. Then you add your recovery rate or appreciation rate, however you want to describe it. And if our market continues to recover at a 6% annualized rate, you add that to the 11%, your buying power is now cut by 17% next year. Now, you're looking at instead of looking at a $300,000 house, you're looking at a $250,000 house. So I did this presentation a couple weeks ago, and an agent called me, and she shared with me now what she does. I find this really interesting. She begins to educate her people about the interest rate environment, those types of things. Then she goes and shows them kind of the higher price level, and then she goes and shows them something 20% less, and says, if you don't make your decisions today, this time next year, this is the property we're looking at, not the other three. And it really puts a visual into the differences between a price bracket of a home. But I find that technique really interesting. And she said it absolutely changes their perspective on things. They now want to buy now. All right. Next thing is, how many remember that after the financial crisis happened, we went 18 months without any jumbo financing? None. Susan, do you remember that?
Yeah.
Susan was our boss, or Lake Forest. I think there was, for a 6-month period of time, there was one sale over $1 million.
Yeah.
It was just unbelievable. But notice what I'm pointing out here is the return of jumbo financing. How many people know we can now do a 5% down jumbo loan again? 10% down to $1 million, a $3 million loan again. And if you take a look at where the buying pool was just 2 years ago, when you had to put 30 to 25 or 20% down just to get a jumbo loan, there's only X number of buyers that fit that profile. When you increase financing options like this, the buying pool grows exponentially. And by doing so, you add more demand for an upper end product, and therefore prices recover at a faster rate of pace. The upper end of the market, because the shutdown of financing, got hit the hardest. But now that group is recovering the fastest in pricing because financing is becoming more available. So my purpose here was just to show you, and for those that tap into the upper end market, is the upper end markets are recovering at a faster rate of pace right now, mostly driven by the availability of financing. We're gonna talk about Dodd-Frank and stuff here a little bit, but there's been a tremendous amount of regulatory change in mortgage banking. When the Dodd-Frank bill first came out, I always loved reading the article that said Dodd-Frank is gonna save the average customer $600 per loan because of the streamlining of the process. Yeah, the last article I read by the Mortgage Bankers Association, they're estimating it's costing $2,400 more per loan. Okay, that's a miss of $3,200. Okay, but $2,400 more per loan because of regulatory change. Okay, now, who's the largest shareholder of Fannie Mae and Freddie Mac? You. You, the public, own 78% of that company. And Fannie Mae and Freddie Mac increased what's called their risk margin dramatically, okay, to recover some of the losses that they're doing. So Fannie Mae and Freddie Mac increased their margins. A Fannie Mae and Freddie Mac loan has all these QM requirements, all these extra tests that we have to do on it. $2,400 spread across a $300,000 loan is so much more in price than $2,400 spread across a $1 million loan. Does that make sense? So what happened earlier this year, remember the main part of Dodd-Frank came in place in January. But when you take a look at it, the dark line up here is our jumbo 30-year fixed rate pricing. The lighter line is the conforming. The message here is jumbo 30-year fixed rates are actually below conforming pricing right now. And that's because the cost structure involved. Okay. It's a combination of Fannie Mae increasing their margins and a combination of Dodd-Frank spread across smaller loan sizes is what's driving that issue. So not only has jumbo rates returned, but jumbo rates right now are actually at some of the lowest levels they've ever been at because of this equation.
Who owns the other 22%?
The public. They could, by statute, the government could only take on 78% of that company. And so what happened when they took it over, basically they seized, so everybody's stock was reduced to only having, the shareholders were reduced to having 22% ownership. The government was given the other part to it. Okay? And they needed to do that to bail out Fannie Mae and Freddie Mac. They pumped in a tremendous amount of money into those two entities. Okay? To the point of, and I'm just gonna throw out probably a number, I'm gonna say it was right around $1.2 trillion is what we ended up pumping into those two companies. Now here's what the media doesn't tell you. Earlier this year, in the first quarter of this year, every single penny of that has been fully returned back to you, the taxpayer. Fannie Mae and Freddie Mac last year made $110 billion. Okay? The government, this is just my opinion here, is going to hold on to Fannie Mae and Freddie Mac because it's getting this tremendous amount of revenue stream coming from it. And if they can hold on to this for 3 more years and keep making $100 billion a year off of it, they'll be able to help reduce some of our deficit because of that acquisition. But what the media doesn't tell you is not only did the bailout of Fannie Mae and Freddie Mac not cost you anything, it's turning into a huge revenue generator for our government right now. Now, what would happen if we, a private company, did something like that? We'd all be in jail. It'd be considered a monopoly. And yet our government does it. And they do it without the media even talking about it. So, all right. Remember, I kind of go back to Ben Bernanke did some very interesting steps. And what we don't hear about is how well all those turned out. So this, I just threw this stat in just so you see a little bit what's going on in the mortgage industry, but I also think we'll tell you a little bit what they're anticipating in the purchase business. In 2013, we did $1.8 trillion in mortgages. 1.2 trillion of that were refis. 600 billion of it was purchase business. This year, I don't even think we're going to do 400 billion of refis. My industry is going through another significant change because when you take 40 to 50% of the volume out of the equation, things have to change. Okay? So we are going to see companies no longer want to be in the mortgage business as we work our way through this winter because of this change. But a key point is in the forecast for next year, notice they just changed this number. They're now anticipating a 20% increase in purchase business. 15% of it is caused to an increase in units, and 5% is driven by average loan size. Or in other words, they're anticipating purchase prices to go up and the units to go up in the mortgage business. This was 5% 6 months ago, and it's been trickling upward based on the economic indicators that they're looking at. We're going to get into some of those here in a little bit. Question?
The bottom number there, total volume, you mean 1.1 or 1130 billion?
It should be 1130. It should be a comma, not a period. All right. Dodd-Frank. How many have heard of Dodd-Frank? Beautiful. It started off being this beautiful 26,000 page read, and then they added 9,000 more pages to it. It is by far the largest change in financial industries in the United States. It not just impacts mortgages or banking, it impacts insurance companies, student loans, auto loans, everything. How many have just noticed in the last year, you get all this additional disclosures that get mailed to you at home? I mean, it's books and books and books. I kept the stack at my house. My stack now is about 8.5 inches deep, okay? I consider myself a pretty intelligent person. Half that stuff, I don't even understand what the heck they're sending to me. So I find it really interesting that the purpose of Dodd-Frank was to streamline and make it more consumer friendly. And to me, it's just done the opposite. Like, what is all this stuff? And it really is corporations covering their liability because of all the new regulatory items to it. So Dodd-Frank isn't just increasing the cost of $2,400 per loan. It's just increasing the cost of your insurance policy, every auto loan that you do, every credit card you take out, every student loan. The regulatory requirements are just amazing now for the financial industries. All right. So, but what does it mean to us? How many have noticed this past year, it just takes longer for a loan to get through? Has anybody been at a closing forever and ever and ever? Okay? And it's because of a lot of the new requirements that are into it. Now, as much as we felt, okay, we've kind of worked our way through this change, we have another change coming. August 1st of next year. How many know what a HUD-1 is? It gets retired next year on August 1st. HUD-1 is now being called the closing disclosure. It will not look like your current HUD-1. How many have heard what a good faith is? Good faith and truth in lending are being retired, and we now have a new loan estimate sheet. In general, this is what the two new disclosures are going to look like. The closing disclosure is actually a 5-page disclosure, but notice what I'm saying, it doesn't look anything like a HUD-1, does it? Here's the part that it's going to be probably the hardest part, it's going to be the change. How many know currently the HUD-1 is supposed to be delivered to the customer at least 24 hours prior to closing? It's actually a law. Has it ever been enforced?
No.
This one now has a 3 business day rule, and it will be enforced. And not just 3 business days, the customer has to acknowledge it 3 business days in advance. Okay? Now that means delivered in person, that does not mean emailed. And if you're going to deliver it, it needs to be through a means in which they can acknowledge, such as, if I send it in a UPS envelope, they have to sign for it, okay? If I'm going to send it in US mail, I have to add 3 business days on top of the 3. So I have to mail it 6 business days in front to assume delivery by the US Postal Service. We're probably setting up a portal where they'll be able to log in and acknowledge the form, through our system. It's what we're doing. I can't tell you what other lenders are going to be doing to meet this requirement. If they do the mail-out requirement, you're now looking at a 6-day wait, if that's what they choose to do. Okay. So then, let's talk about something else. Then if something significant changes, a loan term changes, let's say, you did the walkthrough, you get to the closing table, and you're like, oh, we want to negotiate the price, we want $5,000 less, the mortgage's got to go down $5,000. We make all our changes, the 3-day clock starts all over again. If there's a minor change, there's certain changes that require a 24-hour wait. We will not be making changes at the table anymore. Okay? Now, here's the good news. Are our closings going to happen smoother? Yes. Getting there is not going to be fun, but the closings are going to go through smoother. And at the end of the day, what does the customer truly remember? How smooth did the closing go? So hopefully we're going to end up with better customer satisfaction, higher reuse of our customers to us, because they're not negotiating at the table anymore. Now, question?
But aren't they going to have a negative feeling in that the closing was delayed a week? Because of
And their
Well,
administrative?
let me ask you a question. Would you rather know that the closing's delayed a week, or the closing's delayed a day or 2 as you're sitting at the table and you have to come back to the table again?
I think at the table, you're gonna make quicker, rational decisions versus 3 days before.
I don't disagree with that. I don't. Well, there's something to say about the pressure point that you're at the closing, and that pressure point causes decisions to be made, okay?
So then, as far as the walkthrough goes, you have to do it 3 days before.
I'm just gonna say this, I sure would want to, because if there's something wrong with the house, I would want to negotiate it and get it done.
But if they haven't moved out yet, what's the
Yeah.
deal?
Do you have
So, or when you do the walkthrough, if you want to get into the renegotiation, at that point, you're not closing either that day or the next day. Because if there's going to be a change, you're gonna be moving that closing out 3 days, most likely. Okay?
Jed, is that gonna be, lender or title companies, to get the HUD out?
There's well, that's, her question was, is it gonna be the lender or the title company? Both are responsible. We're probably gonna take the action that we're accountable for it, and therefore we're going to do it. Somebody else might say, nope, we want the title company to be responsible for it. But then they have to take the risk and know that it was done correctly, and they have to warrant that. By the way, the penalty could be up to forgiveness of the loan. What title company do you think is gonna wanna take on this responsibility? Okay? I just don't, I think the title companies are gonna say, lender, this is your problem. You tell us what documentations you want, and then we'll meet those requirements. We're taking the stance that we're gonna work through it. Now, Burnett Title and us have already been working on this project for over a year. Okay? This isn't new legislation. It's just the clock is coming up where it's gonna finally be pushed into play. And so we will work and try and educate you to the best of our ability over the next X number of months as we move toward this date. Now, the problem is, we can only tell you what our 2 companies are going to do. I cannot tell you what the rest of the world is going to do in their decisions. I will probably be the one stomping my feet and saying, if you go with another lender title company in the month of August, you're putting your customers and your transaction at risk, because I don't know how the other companies are gonna handle it. Okay, question?
where does the attorney fit into all this?
Isn't that interesting?
Yeah.
So here's the part, is we begin the process now of trying to educate the attorneys. You know what most of the attorney comment is? This is what, when, what? They don't even know it's coming. I don't know.
So Sue's gonna
We
stop
talked about this at my last.
credit
closing.
checks 24 hours before closing.
We will, well, that's, so his question was, is this gonna stop the credit checks 24 hours before closing? The answer for us, the answer is yes, we're gonna be moving it up. We're actually working and negotiating. See, the problem is, you have these reps and warrants, and almost every lender in their definition with Fannie Mae, they like to see it within 24 to 40 hours prior to closing. We're gonna be moving that up, and we're gonna take the business risk then of doing it probably 4 days prior to closing. Okay. Is every lender gonna do that? I can't speak to what they're going to do. And what it could happen, and what he's referring to, is almost every lender now does a soft credit pull right before closing. And if there's information in that pull which changes their qualifying, okay, everything stops. Okay? And in this case, it would stop, and now the 3-day clock would have to start all over again if there's a significant change in the terms of the mortgage. All right? So, you kind of see how our behavior is going to have to change when this rule comes into effect.
I can see it's going to make a change for all parties, including us, because who's that customer going to call when they get that HUD that they don't understand?
Correct.
And are we supposed to be responding on it? Probably not.
The attorney.
So, change is coming. All right.
Can I, quick question, so they're gonna change, like, writing a check, for things that come up?
Well, for the most part, now, the funds have to be live funds, they have to wire in the most title companies will accept up to $1,000 in some other form of,
Under the table stuff going on.
well, as far as the under the table stuff, I mean, us as on the under the table stuff now is such a high issue that I would only suggest never partake into it because it's your license at risk. Because yes, do we think it goes on? Of course we think that. But are we gonna now take this stance where if it's happening, the answer is no, there's not a loan going on that item. So you're putting your entire transaction and you're putting your license at risk anytime there's something happening off the HUD one or off the closing disclosure. They're not joking about these changes this time through. And the enforcement on some of these policies are huge. The problem is, they haven't been enforcing all the old laws, so they had to create new laws. So they have something fresh. And because if they've never enforced the 24-hour on the HUD, how do you go out and start enforcing it? So.
Just like the dates they added to the contracts now, which are ridiculous, because they can't even meet a closing date, let alone a date when it's gonna get.
Correct.
So John,
So actually, let's talk about the timeline now. So we're talking about getting a settlement statement, which is the balancing of the numbers to the customer 3 days prior to. It really means the lender better have their instructions to the title company probably 4 or 5 days prior to closing. Which means the loan would have to be approved for that standpoint, which means the loan should be approved a week to week and a half in front of that.
Right.
Okay, not the day before, okay? It's really going to change the timeline of how things happen. Your closings, instead of being a 30-day closing or 45, might be a 45 or a 60-day now, just to give everybody the ample time. But the good news is you'll know a lot longer in advance if you're not going to meet a closing date. You won't be finding out the day of, okay? You'll at least have a 3-day notice.
That's why I'm here.
The mortgage forgiveness debt relief expired December of last year. So what is that? That's short sales. So when the crisis happened and the meltdown happened, we had a significant number of properties that were underwater. And the IRS at that time, well, they still do, but any forgiveness of debt becomes a taxable event to the consumer. And so they created this mortgage forgiveness debt relief to allow the forgiveness of a mortgage debt up to $1 million exemption. So they don't have to pay taxes on that. That expired last year. Everybody thought it was going to be renewed again this year. Everybody thought if it was going to happen, it was going to happen before the election. Elections come and gone, and it never got extended. How many have been involved in short sale this year? Okay. The seller on that now has a tax burden. So for every $100,000 of debt that was forgiven, they now have to pay federal and state income taxes on that. So let's just say that number is $36,000. Now, the good news is they got relief from $64,000, but they didn't get the relief on the taxable portion of it. So a lot of people are gonna have a little IRS tax bill coming due that they weren't anticipating because everybody was hoping that this was going to be extended. Or they weren't informed correctly whether going through the short sale process of the tax liability and consequences to it. But just a reminder that this did not get extended. So earlier this year, there was a very significant proposal made. What happens when your government borrows a tremendous amount of debt in order to get out of recession? It's now time to pay it back. And how do you pay it back? You either increase taxes, or you decrease expenses, or a combination of the two. Our political system now is coming up with ways of increasing taxes. It's time to pay the bill. And so there was a major proposal brought up at the end of February. And if you haven't gone out to NAR site, they've got a great item that covers 10 things that agents should know. I'm going to only talk about 2 of the 10 items that are on here. First one is the home interest deduction. Currently, you can deduct up to $1 million of a first lien mortgage on your property. This proposal is going to bring it down to $500,000. It's going to step it down $125,000 a year until we get to that level. And this, for the most part, is exactly what we were anticipating. It's been talked about. So it pretty much meets all of what our expectations were, except for one thing, and it's just a minor thing, but the $500,000 limit, they didn't index it. And what I mean by that is, it's set at $500,000, and 10 years from now, it could still be $500,000, even though loans go up. We were hoping they were going to tie it to some form of an index, but they didn't. Now, the good news is, this proposal also states that it would grandfather in any loan. So any loans done prior to this change would not be impacted. It would just be new loans going forward. Now, in the upper end market, I anticipate a heavy amount of cash out refinances up to $1 million prior to this, so people can maximize their tax deductions. Okay? Now, once again, this is just a proposal. This has not been passed. It is just getting a lot of momentum on it now. Notice it was proposed by a Republican, okay? And the Senate was just taken over by the Republican Party. I now anticipate, and if you've been hearing it, the first thing is corporate tax reform. Number 2 will probably be personal tax reform. All right, this is the punch in the bill that we weren't anticipating. And this is the one we gotta get some momentum behind. And that is the property taxes will no longer be deductible. This could change the percent of home ownership. This is a big one. This doesn't just impact the upper end, this would impact anyone. Okay? So, big change, and this is the one I can't suggest enough. You reach out to your associations, you reach out to your congressman, and you start the grassroots effort trying to enlighten people on how damaging this could be. All right. So now we're going to talk about.
Can I ask you a question? On the one for the interest deduction, was it loan amount of $500,000 or interest of $500,000?
Mortgage amount of $500,000.
Mortgage
and then the
amount.
interest associated with it.
Got it, okay.
Okay.
But it did, you flipped away from it to some, that bottom part about less paid or accrued by a business or someone else.
What that is an investment property.
Right.
Because an investment property, you would still, the proposal would be you'd still be able to run it through your Schedule
As
E
a business
as a
expense.
business expense. So in other words, it would just be the exemption, you lose the taxable deduction on a personal use or property. Okay? In other words, let's just say the average person is, pick a number, 36% combined state and federal tax bracket. If this gets passed, your property taxes now just went up by 36% on a cash flow basis. So if you're paying $10,000 in your property taxes, you now have to make another $3,600 just to pay those $10,000. That's the impact. Okay?
It's huge.
At the same time, it looks like our property taxes are gonna continue to rise anyway.
That is correct. But now imagine how much more accountable the public would put on their state and local pay when you can't write them off anymore. I mean, every dollar now costs you $1.36 to make. So it's gonna be a big change. Once again, this is just a proposal, it has not been passed, but this is what's being talked about at this time. Okay, so now we get into what's going on in the economy. How many remember September 14th, 2008? It was a Sunday. It was my birthday. I was not watching football, and I wasn't celebrating my birthday. I actually was glued to the TV. It was the day we watched Lehman Brothers, AIG, and Merrill Lynch go down. Everybody remember where they were now? So obviously Lehman Brothers, they chose not to save that company, and it was closed down. AIG, do you remember that they spent $160 billion that weekend to bail out AIG? And how did we as taxpayers feel about that? Okay, not good at all. And then what, 60 days later, they put another $80 billion into it, so now they're up to $240 billion into a company, and us as taxpayers are going, what? How many of you know, about 14 months ago, we sold our last ownership of AIG. All of our money has been fully returned, and we made a 40% rate of return on our money. The bailout of AIG cost you, the taxpayer, nothing. And once again, it was absolutely a phenomenal investment in which we made 40% rate of return on our money. Okay. Merrill Lynch didn't cost us anything, it just got taken over by Bank of America. And I do think, looking back, I do think the Fed wishes it would have acted differently with Lehman Brothers. Because when Lehman Brothers went down, it actually put more fear into the market, and it probably caused a crisis to get worse than what it could have been. The biggest reason why they let Lehman Brothers go down is it was owned by a British firm, and they felt it wasn't their jurisdiction to step in and save a company that was owned by a foreign interest. Now, what a lot of people don't know is they actually reached out to the British government and asked them to step in and save the company. And they said no. And therefore the company was let go on their own. I don't think the Fed would do that same action again. I think now they're looking at it that even though it has a foreign interest in ownership, if that company plays a significant role in our economy, it is in the economy's best interest that we step in and intervene to it. So I do think we're going to see, on a go forward, a different action by our government, even on companies that might be owned with a foreign interest. And it may not even be a financial company, it could be an automobile company. It could be some company that has a significant impact in our economy. And once again, I think this was a lesson learned, because I do think if they would have saved Lehman Brothers, the crisis would not have gotten as bad as it did. Question?
What about the other side of the coin, the too big to fail concern?
I think that's been dismissed, to be honest. Well, actually now what's happening is it's actually being driven where if it's too big, they won't let it fail anymore. But now, because once you're, like, now pick the banking industry, once your deposits in your business gets to be a certain size, the asset requirement that you now have to put on reserves is significant. And the amount of federal insurance you have to pay has increased dramatically because that you've now entered that type of a company that the government says we now have to prevent you from having a collapse. Now, it doesn't mean that they can't go in and seize the company, okay? And so I think it still puts everybody on call, but we've seen a significant increase in the amount of reserves financial companies have to put into place just to operate on a day-to-day basis. And hopefully that will protect us from, not that collapses still won't happen, but deep collapses happening into our system. All right, So here we were on that Sunday. We had just experienced a couple months in front of it, the Dow going, basically if you take a look at it, we went from 11,000 to 14,000 in about 8 months or 9 months. Everybody, I kind of call it our economy on cocaine. Everything was going really good, okay? And then we hit 14,000 and nobody believed we even should have been at 14,000, yet there we were at 14,000. And then on that weekend, we were already at about 12,000, but that's when the collapse started happening, and within 3 weeks, we went below 7,000. Everybody remember that?
Yeah.
I mean, on that Sunday, we didn't know if the Dow was even gonna open up the next day. We didn't know whether, you didn't know whether your bank was gonna be open, because remember the talk about running money on cash and all those types of things? And they did all these discussions once everything closed on Friday night, and the discussions took place all weekend long, and we were just glued to the TV watching what was going to happen. So now let's take a look at what did happen. So there's our collapse, and then our Fed started putting its plan into place. And notice where we are right now. Like I said, yesterday we went through 17,500. Not only have we recovered to what we thought was an artificial high, even at 14,000, we are now 3,500 points above the highest level ever in front of the trash. That is a 25% higher than the number we didn't even believe was right at the first time. And this is driven because our economy is the only major economy in the world that has been running for almost 5 years with positive GDP. Where else in the world do you put your money? And the money keeps flowing into the United States. And if you remember when I was here last year, we were at 16,000 and change, and I said we were going through 17,000. And we went through 17,000. 2 weeks ago or 3 weeks ago, I was doing the expo, we were at 16.3, and I said before the end of the year, we're going through 17,500. We just broke through 17,500. We will go through 18,000 probably before the end of the year. Because there's nothing stopping the money from coming into the United States right now. Where else do you put your money? All right, now let's talk about unemployment. So notice, remember we talked about that 6% was the magic number, but anytime unemployment drops below 5%, the Fed really gets concerned and starts doing its actions. Do you remember when the Fed started taking its 17 steps? It was in late 2004. And if you take a look, when did unemployment drop below 5%? Late 2004, early 2005. It's when the Fed got concerned and wanted to slow our economy. And it couldn't move fast enough. Then the crisis happened, unemployment went all the way up to 10.2%. And then it's been slowly improving. The Fed, ever since the crisis happened, said it is their goal to get unemployment back below 6%. Last month, unemployment hit 5.9%. This morning, the new number came out, 5.8% unemployment. They've achieved their goal. Why is tapering stopping right now? They've achieved their goal. Question?
Yeah, but the unemployment number doesn't include those people who are long-term out of work that are.
Never has. It never has. And I get your argument, because there definitely is an index out there that covers that as well. But those two indexes have been going down in parallel together. Now, actually, the numbers really got skewed for a period of time. Right when the crisis happened, that next 2-year period was the lowest percentage of people ever retiring in our country ever. It actually was the highest period of people going back to work that had retired and now they needed to go back to work. Okay? Now this past year has been one of the highest retirement rates ever. Why? Because the Dow hit 17,000. People's assets have been returned. On that Sunday, we watched our retirement program go from a 401k to a 301 to 201 and a 101. And now it's gone back to a 201 to 301, a 401. It's now a 501. If you didn't move your money out of the market, your money is now up 25% in comparison to where you were pre-lockdown. So I thought the unemployment period that we're in right now was probably the highest I've ever experienced. And then I did my homework. Notice 1982, we were at 11.4% unemployment. And what were interest rates at the time? 18%. And notice how dramatically different this recession has been. Now, this recession had a financial collapse involved with it. I think the biggest, how many remember grandparents that went through, or relatives that went through the Depression? Were they scarred for life?
Oh, yeah.
We are all now scarred for life based on the events that we went through. It just wasn't high unemployment. It was a combination of high unemployment, friends, family losing jobs, friends, family losing their houses, and all at the same time, our assets became worth 50% less than what they were. There was no matter how safe you thought you were, there was nothing protecting you in that entire collapse. Because of that, our mindset has changed. I think as you work with your customers, and they say the older they are, the deeper that scar is, I think it's important that you acknowledge that scar, but you help people look to say, did you really know we're almost 5 years through the recession? Because how many of us still feel like we're still in it? And you have to work them through that emotion a little bit. It's safe again. It's time that we can take a little bit of risk and move on. The stock market, pre-meltdown, did you know it was at the high point of 14,000? But did you know today it's at 17.5? That's 25% higher than pre-meltdown. It's okay to move out again. But we all are scarred. They say if you're over 30 years or older, you're going to carry that scar for the rest of your life. If you're under 30 years old, you didn't have anything to lose during the period of time. So.
Kind of like in the 80s, I don't remember that.
Cocktails.
Reasons why. All right, but I just wanted to point out that unemployment item there. So definition of recession is 2 quarters in a row of negative GDP. Okay? So here we were, here's our meltdown. We went through 6 quarters of negative GDP in this country. And then in early 2011, or excuse me, 2010, we hit positive. We then went 16 quarters, 4 years of positive GDP. This is why the stock market is doing what the stock market is doing. It's consistent, stable growth in our country. Once again, probably the target, like the Fed said, they wanted at that 2.5 to 3% growth rate. And now let's take a look. How many remember this past winter? Okay, tough one, wasn't it? Not only a tough one just because the weather was bad, it was a tough one for business throughout our United States. It hit the East Coast, it hit the West Coast, it hit the South. It actually caused us to have a negative quarter of GDP, and everybody's blaming the weather on that one. And notice it quickly came right back, but notice these numbers, okay? This is why the Fed is saying it's trying to slow down our economy. It's running too hot. And now it's time to begin to put the brakes on the economy a little bit. Okay? Question?
Most of the statistics you're showing us is for the whole country.
Yep.
The state of Illinois is slightly worse off.
Slightly worse,
Yeah.
but running in parallel.
But running in parallel, yeah, but because of, I mean, are there specifics?
But I'll use the state of Illinois, and the answer is yes, but let's use the state of Illinois unemployment number. Pre-meltdown, it was already 2.5% higher than the national average. In the worst of the peak, it was about 3% higher than the national average. Where's that right now? About 2.5% higher than the national average. So it's gone almost in direct parallel to it. The one number, which is different for Illinois than for most of the country, is the foreclosure pattern. Because in Illinois, there's a 12-month hold on the foreclosure process versus a 6-month hold, these average sales prices and the collapse in real estate didn't happen until 6 months later, but the recovery didn't happen until 6 months later. And so when I watch the national averages going on within real estate, it gives me a great forecast of what's going to happen here in Chicago. And so the good news is the recovery rate has just begun declining, and we'll get to a graph on that here in a second. but it has begun to decline from like an 8% rate down to a 6% rate. I still think Chicago's recovering at the 8% rate, and then it will drop down to the 6% rate. Okay. Answer your question, then? I also think, you know, that one challenge in Illinois is also the complexity of the financial condition of the state and the city. And, you know, and so there's another underlying problem. And that problem really got deeper because it got hit with the monetary, when the financial collapse happened, it impacted the local governments here harder than some areas in the country. So this is the GDP of all the top countries in the world. And how many remember, it used to be the dollar that was the worldwide currency, and then it got changed over to the euro. Everybody remember that? The reason why it got changed over to the euro is because the euro area became a larger GDP area than the United States. Do you remember when the US went through the recession? Do you remember that it was the euro area, it was Britain and it was Germany, basically said that financial problem is just your problem, it's not going to come to us. Well, the euro area now is just coming out of its 4-year recession. It just had its first positive quarter of GDP, you can see it up there at 0.1%, is its first positive quarter of GDP in over 4 years. Because of it, their GDP has been shrinking. At the same last 4 years, ours has been growing. And because ours exceeded theirs, it was about 4 years ago that the dollar returned back to be the worldwide currency. Notice, I'm just going to pick on one here, but notice Russia's right here. There's been a lot of news this past couple days, and part of the news gets buried. But how many know that 2 days ago, Russia stopped supporting its ruble? And what that means is their currency is going to plummet. How many have noticed that oil dropped below $80 a barrel? Yeah. Okay. What is Russia's #1 revenue? Oil. And it costs Russia somewhere around like $70 to pull it out of their ground there, where in Saudi Arabia it costs them like $25 to pull it out of the ground. So when oil prices drop to that level, it dramatically shrinks their margin. And 2 days ago, they were supporting their currency by pumping $2 billion a day into the support of their currency, and now they've discontinued that. And the currency will be in a free fall until it finds its own natural level now. Now, if you're a billionaire in Russia, what do you do with your money? You get it out. Over the last 2 years, the amount of cash coming out of Russia into the United States has been at historic highs. The last 2 weeks broke every record. Okay. And now it goes through its free fall. It is our anticipation that in the next 6 months, Russia will enter a recession. This past year, we put sanctions on Russia, and now oil has dropped below $80 a barrel, and now they just let their currency go. And this will impact us. This will have a negative impact on the worldwide economies because of it. So, anyways, so here we are, and as you can see, is when you take a look at all these numbers, so the euro area is just coming out of its recession right now. It's very challenging to invest into China. And by the way, if your GDP is growing at 7.8%, is that healthy or not healthy? Not healthy at all. China saved the world this last recession by being able to buy all our debt. China no longer had that financial position, and there is no country right now that would be able to step up and help the world come out of it. Like right now, if Russia needs to borrow money to stay afloat, who they can borrow it from? Can't borrow from us, we don't have it. Can't go to China, they don't have it. Who do you go to?
They're going to steal it from somebody.
Well, partly is, when you take a look at it, why were they trying to take over that whole peninsula and take over some economic moves? When you look at it, they're looking at the protection of their economy, and they needed growth to it. And one way to do it is go out and take it.
Right.
Okay? They didn't. Now, the sanctions have been more painful than they thought. All right. So a little bit about GDP with countries. So remember we talked about scarring? So when I say the word inflation, it makes the average person go, "Hmm," okay? Now, where did that come from? 1982, okay? Because we read in the media every single day, inflation, 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 and we just turned inflation into that negative word. All right? Who in here wants to make less money next year? Anybody? Who wants your house to be worth less? Your assets to be worth less? Inflation is just another kind of a fancy word for growth. We need, for a healthy society, we need controlled, moderate growth inflation. Our government has targeted, almost historically, somewhere between 2 and 4% as our desired inflation. And notice right where we're at on the inflation standpoint. So inflation is really at check. Remember when I said the economy's been growing too fast? They don't want to see a spike in inflation, so now they're gonna start bringing the economy down a little bit to be able to control the inflation index to it. Okay? All right. Consumer confidence. This is probably the most important index for your business. Consumer confidence is the best indicator on how people feel about large ticket purchases. And what's a large ticket purchase? So here we were, okay, pre-meltdown, and notice the index was well over 100. I call this our economy on cocaine. Okay, we were all feeling good. And then all of a sudden the crisis happened, and notice we dropped under 25 points on the index, which is the lowest the index has ever measured. Remember I said we're all scarred for life? That is what scarred us for life right there. We stopped believing in the institutions, our government. We just don't think about it the same way. But then the recovery began, and we started improving our confidence again. And now notice the last 12 months. We've been running mid-80s into the consumer confidence. And it's that consistent improvement in the consumer confidence is why they're now projecting an increase in home sales for next year, because of this consistency.
But the media keeps reporting that.
Media doesn't tell the story. No, I mean, you know, when I first started working with Ralph Burnett, when I heard him tell me that my biggest competitor is the media, I didn't get it. Boy, do I get it now. It is, we will fight public perception based on misinformation. It's the twist that we put on information. And I'll go back to inflation, right? So, and just watch the next time you hear the inflation report. Oh, the consumer confidence index just came out today at a 0.3% index, okay? And it's spun negatively. You know, that means our basket of goods went up, blah, 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 blah. 0.3%, okay, is perfect inflation. Why aren't they saying the inflation came in right within the zone that the government is trying to do? Our growth is at its perfect level, and nice job, government. Nice job. But it's not the spin they put on it. The one I loved was they came out and its inflation was at 0 this month. Yay, they're all talking about it. Who in here wants 0? Who wants 0 growth? And yet, they were spinning it as a positive. It's really interesting how the media takes numbers and they spin them to a story. All right. So now, we just went through October, and obviously the last month that was reported here was September. When the October number comes out, it's going to go down from here. Why? Number one, the election. For some reason, consumer confidence goes down because we can't stand listening to these political ads. How many are just glad the election over just because? I've never muted a TV more than this past time. It's just unbelievable. And the second item is Ebola. Ebola hit us in October, and it changed how many people, I mean, international travel is down 45%. Okay? Ebola, just that unknown adds uncertainty into us, and it's going to change our consumer confidence. So I project that we're going to go into the 70s in October, mainly driven because of the election and Ebola. Now, the good news is, we're now in November and December. And November, December, because of the holidays, is the feel-good time. So we're going to bounce right back up into the mid-80s again as we go through it. especially because we all feel better. Why? Because we have to watch another political ad on TV. Okay?
For a couple weeks.
So, all right, now we're gonna get into the affordability index. This, to me, is an important stat information for consumers. So here we were, cruising along, and the affordability index is really driven primarily by three elements, okay? It's driven by people's income, it's driven by interest rates, because obviously lower rates go, the more affordable a house is, and it's driven by home prices. And so if home prices go down, it improves affordability. If home prices go up, it brings affordability down. So what happens in a crisis in which homes drop 25, 30, 40%, and interest rates go from 6% down to 3.75%? Affordability skyrockets. And so here we are, and notice we got up to 210 on the affordability index. And this is my 4th year doing the presentation out here, and I keep telling you we are in that window of opportunity to buy real estate in this country at its best time ever. But that window is going to begin to close. So what happens when rates go up a little bit, and what happens as homes values recover? The affordability index comes down. And so we've gone from 210, and we're at about the 160 point level. Okay? What's going to happen to rates in the next 12 months? Going to go up. What's going to happen to home values? Going to go up. What's going to happen to the affordability index? It's going to go down. Okay? So this is, let's ask the question differently now. So now that we know growth or inflation, we're really trying to target that 2, 3, no more than 4%. If this room could pick the appreciation rate on homes for the next 20 years, what rate would you pick?
3.
3? Okay, 4. 3, 4, anywhere in that period. So here we were pre-meltdown, and notice we're running right between that 2 and 4% bucket. Perfect. Then 1998 happened. Ooh, we went above 4%. Okay, we kept cruising along. Ooh, then we went above 6%. We went above 8%, and for 18 months we were above 10% appreciation. 9 years of running on top of 4%. The housing value bubble was absolutely forecasted. The depth of the collapse was never forecasted. But everybody thought a price correction was going to take place based on this graph right here. So now notice the graph came down, but notice now we're back, and I call this recovery rate. We got back to an 8% recovery rate, and now we're sitting at 6% on the recovery rate. Remember I said Illinois is about 6 months behind the national average? You guys are up here right now, coming down. And where are we going to end up? We're going to end up right back here. We will be there hopefully 1 year from today. Actually, Illinois, probably 18 months from today. There's the extra 6-month issue to it. We're going to be back to the norm. This is when I'm going to stop saying recovery rate, and I'm going to go back to saying we're finally into normal appreciation time again. Everything's turning back to normal. The government's stopping suppressing rates. Things are coming back. Things are turning back to normal.
Why do some areas, East Coast, West Coast primarily, have those indexes at higher levels and sustain?
Supply demand. Supply demand.
I mean, you could see that, and they come and crashing back
Right.
and forth.
And
Look at California, how
I'll
often.
pick on certain areas in California, pick certain areas of New York, is the ownership rate is actually less than here in the Midwest. Okay? Therefore, owning property is harder. The demand for it is larger, okay? Because more people are renting as opposed to home ownership. And therefore, prices are stabler because you don't have as many people in that market. Now, when the market does move, it usually moves in front of us, and it moves faster because the market is a smaller market. Okay. All right. So this graph, I've shared quite a few years. It's actually one of my favorite. It goes back to 1890, okay? Now, this shows you, this is the Depression, okay? This is the 1970s. Right there is when my parents bought their first house. By far, one of the best investments they ever did. In the 1980s, this is when I bought my house. By far, one of the best financial investments I did. We went up to 210. The window we are in is the best window ever to buy real estate. And now we're coming down. And the window's beginning to close. And we have about 18 months left of the window. And then the window will be over. And we're gonna be right back down to these levels in here. Why buy now? This chart. So key points to remember again. A 1% increase in interest rates is 11% change in buying power. To that, you add in your very specific market what you think the recovery rate is going to be over the next 12 months. And that's going to be the impact of buying power. Now, so we talk about it, is if next year we're at 6%, that's a 17% decrease in buying power. And if the next year we go through another 1% increase in rates, and the recovery rate drops to 4%, okay, that's still 15%, but in the next 2 years, we're gonna see a 30+% decrease in buying power. Buying a $300,000 house today, they're buying a $200,000 house 2 years from now. Why buy now? Why move up now? Those two stats right there. It's now is the time. Not this spring, not a year from now. Now is that time. Question?
I thought one of the slides showed an increase for 2015, even though this is going to happen for home prices and,
Correct.
so I guess the two I'm not.
Home prices are going to continue to recover, okay? But that decreases affordability. And once again, does the average person jump in and buy stock as the stock market is getting ready to improve, or they jump in the market after the stock market has moved? After the fact. There is going to be a large population that's going to jump in now after the fact, because they've been burnt, okay? They're scarred, they're afraid to make a move, but now when they start seeing things go, okay, when they start seeing interest rates go up, fear drives action. They will now begin to come out and purchase property. Problem is, they're gonna be a year too late, they're gonna be 2 years too late, but it's going to happen. Okay, now, how many of your past customers are currently sitting with a mortgage at 4% or below? Okay, and when rates go back to 5, or let's say rates go back to a 6% level, how tied are they going to be to their current house based on their mortgage payment? Okay, so as you start working with your customers, it might be a great mailing to put out right now. If you're considering making a move, okay, now's that time. Because if you wait, you won't make a move because your mortgage rate will be so below the market that you're gonna be froze on making a move based on that reason. Okay? Best person to get involved and to change the mindset about where rates are going to go and to get comfortable with it is just you. We're gonna be selling houses regardless of where interest rates are. Interest rates going up is a healthy thing. We just gotta get our mind around that. And by the way, we should be applauding it that we're finally getting back to normal. Okay? Now, a little bit of education is gonna change our consumers' attitude around it. But I would rather be telling my customer, buy now because rates are going up, because then when rates go up, what part of buy now didn't you understand, you know? And by the way, rates are gonna continue to go up, so buy now again, buy now again, buy now again.
How does this translate to a seller's perspective? Because the buying pool will be smaller as the rates go up.
Like I said, if you're a move-up buyer, now is the time to move up.
If you're a seller.
And now but if you're the seller, if you're moving up.
Okay.
The person that's going to be the question is the person that's moving down. Okay? If you're moving down, and if the housing is going to recover at a 7%, 6% rate over the next 12 months, and I'm gonna move down, I would probably say wait the next 12 months, get depreciation on your home, the recovery rate on your home, and then buy down at that point. Except the change in interest rate is going to devalue, because that rate change impacts it by 11%. So it really still makes more sense to move down now, because the rate impact will be there. Now, if they say, but I'm not even gonna take out a mortgage, I'm gonna pay cash for it, then they're the client, I would say, then it's the perfect time to wait. Wait until your house is now recovered more, and the appreciation rate returns to a normal 2 to 3%, and now's the time to make that move. But if you're moving up, if my house is worth $300,000 today, and I want to move up to the $800,000 price range, right? And if the next year I recover at a 6% rate of return, my $300,000 became $318,000. But the $800,000 house, okay, takes 6%, is now $848,000. I lost money. Moving up, now's the time to move up. Moving down, if you're taking out a mortgage, now's the time to move down. Move down paying cash, I'd wait a year. All right, so looking ahead to 2015, it's going to be another really good year. And yep, our growth is going to continue in this country. It's going to begin to slow. The housing recovery has another 12 to 18 months in this marketplace. Unemployment, their target is to drop now down to 5.5%. Once they get down to 5.5%, the Fed's going to say, we're done with the jobs, and now we're going to be focused on inflation and growth and keeping it stable. But the stimulus will be completely out of the market 1 year from now. Consumer confidence is going to continue to be strong. The tapering has ended, and the global markets are going to be recovered, except for, like I said, the curveball that was thrown in 2 days ago was now Russia possibly going to slip into a recession. All right. So a year ago when I did the presentation here, here's where our top 5 concerns were. The European debt crisis. Remember Greece? Okay. The U.S., the fiscal cliff, world peace or not, oil, China. This is, I filled up gas in Minnesota. I'm telling you, I smiled the entire time I was putting gas in my tank. And not only that, I noticed everybody that was filling up, we all had smiles on our face. I mean, to spend less than $100 to fill up my tank was beautiful. I was just in Naperville, and they were at $2.92 per gallon.
309 in Schaumburg this morning.
Yeah, it was 289, that's good.
So,
284 in Lake Zurich.
now, like a stat, I just heard about this. If gas can sustain this level, this price level, for the next 12 months, for the average person, that's a $2,000 cash flow improvement.
Wow.
Isn't that amazing? So anyway, I threw that one in there. So our current top 5, world peace or not, ISIS is still on our minds. U.S. monetary policy, the tapering is done. The Fed increasing of rates is going to be coming. The European crisis, they just had their first quarter of positive GDP. Do they slip back? Or do they keep the growth cycle going? China, the concerns are rising. Their inflation rate is too high. And once again, it's a key component of the world format. We hope we can get that set down. By the way, I might be adding Russia to this list now as we work our way through that. And the last one is Ebola. Ebola could have this negative impact to worldwide economies because tourism is one of the largest worldwide sectors, and it's being impacted dramatically right now. And a decrease in a lot of countries' tourism could negatively impact the world based on that. So, why buy now? We have 18 of the last 19 quarters have been positive quarters of GDP. We are coming up to the 5-year point where the recession has been over. Unemployment today was announced at 5.8%. The Dow is 3,500 points above the pre-meltdown level. Home affordability has peaked, but the window is still open. Okay. Home values are still going to recover, but interest rates are going to be going up at a faster rate than home values. So, on behalf of Sue and Susan, I thank you for coming out today. I hope our discussion today will add a couple bullet points to your presentations to your customers. But more importantly, I hope that it shapes your philosophy on what you see going on in the economy. Because if it changes the way you look at it, it's going to change the way that you sell. And if you can change the way that you sell and take away those fears from your customers, you're gonna sell more homes. So, any questions?
Can we get a copy of the PowerPoint?
Sue and Susan have a copy of it.
Oh, yeah, so I know you guys are taking pictures, just, if there's certain ones you want, or you want the whole thing, I'll take the whole thing.
Is it possible to do a marketing piece with the combination of the increase in interest rates and then the affordability? You know,
We have that, the 11%.
I know we have
We have
11,
the-
but combining the two, that makes more money.